Hi guys, welcome back to another video. My name is Josh, and before I begin, I'd just like to say a big thank you to all of you guys who've subscribed to the channel. We recently hit 1,000 subscribers, and I really didn't think that we'll make it that quick. In just a span of about 8 months, we made it. Okay, so if you haven't subscribed already, be sure to like and subscribe, as well as follow me on Instagram to get updates on my public portfolio on my Sharesies account, as well as other New Zealand stock market news. In this video, I wanted to talk about Summerset stock because it's been a stock that has been hit quite hard by the entire situation. So today we'll take a second look at Summerset to see if it's worth investing or not. So I've covered Summerset on this channel before, but a lot has happened since. So in this video, I thought I'd do an update on what's happened, as well as see whether the numbers stack up and whether it's a good buy at the current prices. So do be aware that I'm not an authorized financial advisor. What I mentioned in this video is not financial advice. You shouldn't buy a stock just because I'm talking about it or sell a stock. If you need specific financial advice, do seek help from an authorized financial advisor. So let's get right into the video. Previously on the channel, I have done a deep dive analysis on Summerset stock. And in this Summerset video that I've made in about November last year, I go into a lot of detail on what the business model is, how they make money. I talked as well about the key risk involved with investing in the stock, and we talked about the valuation. And to sum up the valuation, I essentially came to a fair value estimate of $8.40. And at the time of the video that I posted, the share price was at $7.25. So that was on the 15th of November 2019. And that represented a 15.8% upside. And the assumptions that I used were a 15% CAGR, which is a compounded annual growth rate for the next 5 years, a discount rate of 11%, and a terminal growth rate of 2%. A lot of things have happened since I posted that deep dive video. So I'll show you guys later what happens to the fair value estimate when I adjust for certain key assumptions here. Since I posted that video till the end of the year, it actually ended the year at an $8.90 price. So at the time of posting, it was around here, and it ended the year above the price target of $8 and about 40 cents. Okay. And since the start of the year, you can see that the price really just cratered. It is down about 40% from year to date. So from about $8.90 to about $5.35 today. What's happened since? So let's take a look at the key developments since my deep dive video. And on the 25th of February, they actually posted their financial results for the year ended 31st December 2019. And in that announcement, they made an underlying profit of 106 million. They did, however, also show that they were slowing down their construction, and that is seen by the fewer retirement unit deliveries of 354 compared to prior year of 454. Okay, and that also signals a little bit of a supply glut in the entire industry because they aren't selling as much, so they aren't as focused on delivering as many units as they were in the prior years. And the CEO also guided for no profit growth for financial year 2020. Unfortunately, the market expected more growth than what the CEO had guided. And so the market saw the announcement as bad news. And that sent the share price dropping from $9.05 to about $7.43 in the following week. So this is the small blip that we see here, and that is a drop of about 18% one week from the announcement. And you can see this is really quite small compared to this big chunk here. And this big chunk here, we all know what's happened, the entire situation that I can't really mention on YouTube. But let's take a look at the announcements relating to this drop. So they provided a market update for the situation on the 23rd of March 2020. And what they said was that there were no cases in the retirement villages or in the care center. So they've restricted access to the villages as well. because the people staying in the villages are seen as the high risk age demographic. Okay, they're usually above the age of 70 and they have a higher mortality rate from the situation. And as well as that, management affirmed the balance sheet that it was able to sustain a prolonged scenario. So if this situation lasts for more than the lockdown period of New Zealand, they'll still have a lot more cash to sustain through that. Okay, and the good thing about Summerset is that they can delay their capex, so capital expenditure like buying more land, building more management can just stop that. So in terms of their operating cash flow, they don't have a high demand. The only high demand cash flow is from paying their staff and paying their suppliers. They have a lot of unused banking facilities to cover that operating needs. Okay, so no cash flow issues there. And what happened was, obviously this entire situation had meant that the shares got literally dumped. So the share price at the start of March was $7.43, and it's dropped to intraday lows of about $3.36, and that represents a 50% drop since the start of March. Let's talk about this situation. So it is really bad times for the sector right now. Firstly, age demographic is at high risk, and there's always a possibility of an outbreak, and we've seen that in multiple rest homes in the USA. We also know that there's a short-term glut in retirement units. As I mentioned before, they haven't been delivering as many units. There's too much supply at the moment, and they just need a little bit of time to let the aging demographics catch up to meet that supply. Okay, but in the short term, there's a little bit of a glut in units. And what that means is that there is going to be less development margins and less resale gains, essentially, because they won't be able to sell as much units. And so this will take a big hit to Summerset's profit. There's a high pressure on nursing staff and increasing wage costs. And we already know that nursing staff was under a lot of pressure from the DHBs before this happened. So add on to the current situation, that would increase a lot of staff pressure. And when they don't have enough staff, they might have to bring in temps, and usually temps would be more expensive than full-time equivalents. So that would cause a lot of wage cost increases. Julian, the CEO, was also mentioning that the reason for no growth is because they had to pay their staff more. And so this is causing a lot of trouble for the entire sector. As well as that, we are in talks of going into an economic recession. And what that means is that the demand for houses will drop. And so housing prices will stagnate or even fall in certain situations. And Westpac New Zealand has already slashed their forecast for house price growth and GDP as the situation starts to hit jobs and consumer spending. And for Summerset, their profit is quite dependent on the housing cycle. So when house prices drop, then their profits will take a hit as well. So I know I haven't been selling this stock very well so far, but I encourage you guys to really think about the short term, but more so focus on the long term, okay? Because when we start to think long term, it actually doesn't seem so bad at all. The aging demographic will age eventually. We will grow older despite the situation. Despite not going out, we'll still get older. And there is no stopping from people from aging. Like I said, demand for units will come back when the grey tsunami hits that peak and demand meets supply. Essentially, demands for units will come back. And housing prices as well will come back stronger, because if you look at the current situation, we have interest rates. The OCR is at 0.25, close to zero. We have the Federal Reserve, the RBNZ, pumping money into the economy. And what this means is that there is a flush of money in the economy. And when the entire situation clears itself, what this means is that asset prices will basically come back stronger than it was before. And Summerset will always build, and they will continue to build once the dust settles down. Okay, they have a land bank of 5,380 units, which means that currently their land that they have is enough to build for 5,380 units. So that is a lot in the pipeline that they have, and this land bank is quite significant compared to their other peers. All right, so now let's talk about valuation. So the current share price is sitting at $5.35, and to tweak some of the inputs to my model, instead of putting the 15% growth, I've put it to 0% growth to reflect that going forward, no more growth. It's a zero growth company. And the only thing that I put in was 2%, and that is in line with inflation. So that's assuming that the company will grow for 2% forever. I think it's pretty reasonable. Housing prices usually go up faster than inflation, but to be conservative, let's just put 2%. And this is no growth, essentially. It's just following inflation. And the discount rate is at 11%. And what that means is I put it all into the model and I get $5.33. And that seems a lot alike to the current share price of $5.35. So what this tells me is that the market is currently pricing in for no growth forever for Summerset, okay? And we know that's not true because once this whole thing settles down, Summerset will get back to building more units. Sales will start popping off once housing prices recover, okay? We don't know when this is, but it's certainly not going to stay at 0% growth for forever, okay? And so I think the current share price it's quite justified for the current situation, but it's not justified for the very long term. And one thing to consider as well is that the net tangible assets per share is $5. So what this means is that if you take all their tangible assets, you sell it all off, you pay back all the debt holders, you pay back the residents for their loans, you pay back the banks, you essentially end up with $5 per share. And the current share price is not very far off from the net tangible assets per share. So you can see that as a margin of safety. Of course, the share price could continue to go down and we don't really know where it's going, but if you're looking for value, then Summerset might be one to consider. All right, so to sum it all up, I think Summerset is facing a lot of short-term problems. For example, the wage increases, the stagnating housing market, as well as the entire situation causing a lot of pressure on staffing, and there's also a chance of the situation spreading in these rest homes. But in the long term, if you think about it, there's a lot of favorable tailwinds. People will get older and this situation will not stop people from getting older. Summerset will continue to build once the dust settles down. So what am I doing? So in my Sharesies public portfolio, I have been dollar cost averaging into my Summerset position. So my Summerset position is at a currently higher cost basis than the current share price. So anytime it falls below, $5, I'll be buying in. And if not, I'll just be dollar cost averaging week by week as well. In terms of my private portfolio, I have acquired stock in Summerset at an average price of about $4.23. So in terms of adding more, I will add if it drops below $4 because I'm quite comfortable with the position that I've already built myself. Okay, if you're looking to get into Summerset stock, then I hope what I've talked about here has helped you form some sort of idea and some sort of thinking about holding this stock, because this stock is really not a short-term play. This is more of a long-term play into favorable demographic changes and favorable tailwinds. Okay, so I hope this video has helped you provide some insight, and hope you enjoyed this video. If you haven't already, be sure to like, subscribe, follow me on Instagram, and until next time, take care.